Hi, so thank you everyone for joining us. My name is Maura Boudreau. I do programs on publicity for the West Hartford Public Library. And we're here today to talk with Michael Alamo with USA Financial and Tax Services. And we're here today to talk about your taxes, upcoming changes, and the potential impact on your retirement. This program is being recorded, and I won't be able to send it out after the presentation, but we'll put it up on our YouTube channel so you can view it afterwards. And let me also, if you do have a question, certainly raise your hand at the end of the presentation or put it in the chat box, and Mike will be able to answer it at the end of the presentation. So let me give an introduction to Mike, and then I'll turn it over to him. Michael Alamo, president of USA Financial and Tax Services, LLC, is a 30-year industry veteran. For the past 18 years, he's a financial service advisor. Alamo has served clientele around Connecticut and New England at his business. Services include comprehensive financial planning, investment and portfolio management, wealth preservation and transfer strategies, and business and estate tax planning. Committed to giving back to the community via educational workshops, Mr. Alamo has hosted many seminars for groups at libraries, churches, and social organizations about a variety of financial and planning topics. And with that, I will turn it over to Mike.
Thanks, Maura. And I want to thank, as usual, the Noah Webster Library, West Hartford, for allowing us to present various topics there over the years that we've been there. I think you'll find tonight taxes, upcoming changes, and the potential impact on your retirement very useful. I always caution people with this presentation, it is rather dense. It carries a lot of tax law and strategies as well. And my goal, quite honestly, in the time that we're going to be together here is to provide you as much information as possible in a short amount of time. And the reason I'm mentioning that to you is because it does go a little quick, and I'm hoping you can all get a little something out of this as well. So I'm going to spend just a brief couple of moments, tell you a little bit about my company, a little bit about industry standards, and then we'll get right into the topic. My company, we practice wealth, as Maura had mentioned, wealth and money management, retirement and income planning, estate and legacy planning, tax planning and tax preparation, which you'll learn quite a bit about tonight, as well as insurance strategies and planning as well. We currently have offices in Glastonbury, New Haven, Bridgeport, Danbury, and Wilton. Just as a quick disclaimer here, this is an educational workshop and it is presented for general information purposes only. And it's not intended as, or recommendations as investment or recommendations for any individual and their specific needs. The presentation strives to offer factual, insightful, and up-to-date information on the subjects we're going to discuss, while providing the public a sound basis for evaluating the facts regarding this information. The examples in the presentation are for illustration purposes only, and we always suggest you consult your own financial professional, or if you make your own financial decisions, make sure the decisions are appropriate based on your circumstances. So unfortunately, we're not together, folks, but you know, this is somewhat of an interactive presentation, so I'll have to take the side of both parties here. What eats into a portfolio value? Well, historically, volatility, obviously volatility, depending on how you invest your money, can have a pretty big impact on that portfolio, particularly while you're utilizing that portfolio in retirement. Longevity is something that's also pretty important on portfolios. How long do we utilize this money? What is the money used for? Longevity, a big impact on portfolio. The one we're going to be talking about predominantly tonight are taxes. And you're going to find that taxes can really affect the successful outcome of a retirement plan, depending on what you think will happen with taxes in the future. So again, we call this, how do taxes impact your retirement? A pretty favorite saving of mine here is one of the core principles of investing, whether it is to save for retirement or generate cash, is to minimize taxes, and strategic allocation from a tax perspective should give your accounts the best opportunity to grow over time. The key here is remember, it's not what you make and accumulate, but what you get to keep. Just briefly on my company foundation, so you understand my perspectives on investing, as well as all the other things we're going to talk about tonight. Our company vision for the folks that we work with: when is the last time these four persons got together and coordinated on your behalf at the same time? And that would be an estate planner, an insurance agent, financial planner, and an accountant. And I've asked people for years, shouldn't they? Because they're all involved in important monetary decisions that are going on in your life. And so briefly, an estate planner typically is preparing your assets today while you're alive and someday when you pass on. So we're talking about money. An insurance agent, again, is typically offering you policies that are reflective of ours, whether it be life insurance or annuities or long-term care, they're reflective of money. The financial planner, that's the simple one. They're looking to manage and help you grow your assets. And the accountant, who has the least advantageous position, it's one of the hardest components of my company, is they're dealing with your tax situation every year going forward. The one disadvantage for the accountant or CPA is typically people are bringing in their tax work in February and March, and you're basically handing them last year's story. That's a closed book. As tax planners, we're trying to improve your tax picture. And I think I'm going to show you some pretty interesting concepts tonight. So I call this the full circle advisor approach, where we're integrating these four aspects into one company. One last thing again on the company, we do practice what is called the fiduciary standard. This is our commitment. And in general, this is where the SEC, the Securities and Exchange Commission, and state insurance regulators hold investment advisors to what is called the fiduciary standard. Some basic examples of that are: an advisor must place his or her interest below that of the client. The advisor must do his or her best to make sure the investment advice is made using accurate and complete information. And the analysis has to be as thorough as possible. And the advisor must avoid conflicts of interest or disclose any conflicts of interest that may arise. So we think this is important for the end consumer to understand the fiduciary standard. Okay, so I'm going to ask you to take notes, write down questions that you have, as Maura had mentioned in the earlier portion, or put it into the chat bar. And these last two here, so you understand this, normally when we're in person, we will hand out a packet of very helpful articles on these topics that we're going to discuss tonight, as well as a little of my biography. I mentioned to Maura earlier, what we did the last time is I'll be happy to get over a handful of these to the library. And if you'd like, she'd be happy to mail them to you, or at your convenience, pick them up at the library to take advantage of an evaluation if you feel it would be helpful to you. So on tonight's agenda here, we're going to talk about the history of taxes. We're going to talk about taxes in your retirement, recent tax changes. This is the big one here that everybody wants to hear about: proposed tax changes, tax-free legacy concepts, as well as tax-free conversion strategies. So I've asked this question a long time for people as I've built this program here. And I've asked people, who's tired of paying taxes? Well, obviously, that's a pretty simple answer. It's usually everybody in the room, and that's why you're attending this event tonight. Who wants a tax-free retirement? Well, if everyone had the druthers, wouldn't you prefer to have all tax-free money as opposed to taxable? And so lastly, you want to ask yourself, what are you waiting for? Because you're going to see in this presentation that a lot of these concepts here are available to you now, and you can actually work towards a tax-free or reduced tax retirement. One of the concepts that I have talked about for quite some time is something I have coined the tax bridge. And on this bridge, it's a one-way ticket to taxes. There's no way turning back here. And you want to ask yourself, if you evaluate your assets and your savings, when do you want to pay these taxes? When do you want to cross the bridge? Well, in earnest, you can actually make these decisions on your own. Now, the concept that we're going to be talking about tonight has been dabbled by quite a few organizations over the years. Here's Forbes magazine that says there's 5 legal ways to get tax-free income for retirement. CNBC says 3 tips to help boost your tax-free income in retirement. The Wall Street Journal recently said how to get entirely tax-free retirement income. And lastly, TurboTax in 2019 talked about the golden year guide to tax-free retirement. So conceptually, this has been out there, and I'm wondering if the consumer is actually paying attention to this. Now, again, had we been in person here, I would have asked you, do you feel taxes will go higher or lower? Last night, when I presented this in Simsbury, there were some people in the audience, and I obviously got a large groan, and people feel in general that taxes will go higher. My job for tonight is to show you from my perspective why I think there are really some troubling statistics here and things that you have to be aware of, and why my belief is taxes will go higher. So you have to have a little of your own opinion on this. The national debt is something that has been talked about for decades at this point, and sadly, nobody talks about it any longer. And my concern is anybody even worried about it any longer? This is an interesting site here. And I've told people for years, way back in the 80s when I purchased my first home, we would have these electric meters on the side of the home, and the meters would constantly turn higher and higher. And we'd be looking for the lights that were on, the air conditioning and the televisions. And this is the usdebtclock.org. And you'll see here on a daily basis how our national debt continues to increase. National debt right now is approaching $29 trillion, which in essence, if the debt per taxpayer was paid, it would cost us each $226,000. Obviously, that's not a feasible solution here. But what troubles me even more than the high national debt is you'll see here the US federal spending of $7 trillion and the budget deficit of $3.379 trillion, which tells me that the tax revenue is only $3.6 trillion. Now, as a financial advisor, someone who's worked in the financial industry for over 30 years, I don't even know if I understand what $1 trillion is. But I tell people, running your own household, if you made $50,000 a year, how long can you continue to spend $100,000? And the answer is for quite a long time, as long as you can print money. And that's kind of the situation we're in now. So this is very troubling for me, and I don't see the trend changing anytime soon. Something very interesting, if you didn't know this, the highest tax bracket ever on the federal income tax level was actually 92% after World War II. And in essence, if you made over $250,000 60 years ago, anything above that was taxed at 92%. As recently as the decade of the 70s, our highest marginal tax bracket was actually 70%. And currently, we're actually at 37%. Hopefully until 2025 or beyond, and I'll explain that shortly. And so again, if we were in person, I would ask you, do you really think taxes, at least on the federal level, are high right now? One of the jobs I had on Wall Street when I started early on is I would study chart patterns, and this is called technical analysis. And this chart goes back to the late 50s, early 60s, where you'll see that 92% federal tax rate, dropping down to 70% in the 70s and currently at 37% now. And the median average, historically, where prices will float around on this chart, is actually 58%. And so one of my concerns as a taxpayer now and going forward is this is very low with that increasing debt. One of the other challenges for our country right now is the solvency of Medicare. I'll bring up Social Security on the next slide, which a lot of people seem to be overly concerned about, and there is actually some good news there. The solvency of Medicare, and this is based off of the Medicare Trustees report recently on their site. The report delivered yet another reminder to the American public that Medicare is undeniably going bankrupt. According to their report, the Medicare Hospital Insurance Trust Fund will be bankrupt in 5 years. So for all the baby boomers coming of age that are going to depend on Medicare, how will they fix this? Because the clock is ticking on this one. Social Security. Social Security has major challenges, folks, but there's some good news here. According to their most recent trust report, Social Security is made up of two funds. And so here's where the good news comes in. The excess trust fund is scheduled to be depleted, and this was recently updated, so I need to change this. Two components. One is the excess taxes collected over the years called their trust fund. This one is scheduled to be depleted by 2033. So we have 12 years there. The other balance of your Social Security benefits that are being projected are ongoing payroll taxes. So as long as people continue to work and pay into Social Security, they estimate that if they do not fix Social Security by 2033 and the trust fund is depleted, you would get about 75% of your scheduled benefits. So the some good news here is you should be able to get some form or some amount of Social Security. And this one has a little bit longer shelf life of 12 years here. But again, another challenge for the government that's adding our indebtedness. One last issue here is the highest debt to gross domestic product ratio was 106% after World War II when the taxes were 92%. Right now, our debt to gross domestic product ratio is actually at 107%. So between programs that are kind of becoming insolvent here, debt to GDP ratio and low taxes, you have to wonder how long that is sustainable. So in my opinion, I feel taxes are going to go higher. If you ask me how high, the answer would be, I'm really unsure, quite honestly. I don't think the national debt at this level, at this point, would be paid off anytime soon. In fact, I don't know if the national debt will ever be paid off, but I think it has to get under control and start reversing course. And one of the most common ways to do that is through higher taxes over a long period of time. Let's go over a little tax regulation. Now, some of this is old news. I hope that you know most of this. So if you do, it's going to be a little bit redundant. And for those that you don't know this, kind of important. In 2017, we passed the Tax Cut and Jobs Act. And this actually was estimated to cost the government about $2 trillion. What they did here is standard deductions were almost doubled. On top of that, so the standard deduction, as if I just back up a second here, for all the tax returns that we do, we see about 88% of people now filing their tax returns on standard deductions because they made itemizing very, very difficult. So the bonus you got was doubling your standard deduction. However, they created something called a SALT tax, S-A-L-T. And most people, particularly in the West Hartford region, would know this. If you wanted to deduct your property taxes and let's say your local income tax, state income tax, well, you're now capped at $9,000. They made it very difficult to itemize that because $10,000 in property taxes here in West Hartford alone is actually on the low end. They have 7 tax brackets and they remain 7 tax brackets, but they were all lowered in percentages. I'll show you that. And they took away personal exemptions. They lowered the corporate tax rate from 35 to 21%. And they created a new 20% deduction for what's called pass-through entities, such as limited liability companies. And this was for qualified business income. And the presentation is too short to explain to you what qualified business income is, but for certain businesses and certain thresholds of income, they were able to actually take those profits from that company and move it to their personal income tax return and take an additional 20% deduction. They removed alimony deductions if you were divorced after 12/31 of 2018. So if you were paying alimony and newly divorced after then, it's no longer deductible. And if you took a mortgage above $750,000 after 12/31, 2018, you can no longer deduct the interest above $750,000. Now, this bill here, called the Secure Act of 2019, in government terms, $15.7 billion, not overly expensive, but major changes here that you need to be aware of. And the biggest one here was the increase in required minimum distributions, which a lot of people call RMDs. What they did is they upped the age the account holder to age 72 from 70 and a half. However, if you turned 70 and a half in 2019 and you had already begun taking your distributions, then you have to continue to take them. But for most of the people, once you hit age 72 now, you have to start taking money out of tax deferred accounts, IRAs, 401ks, and the like. What they did is they gave us an additional 18 months to take money out. However, this was a big change for multi-generational wealth transfers. IRAs inherited from the original owners who had passed away on or after January 1st, 2020, require many of the beneficiaries to withdraw all of the assets from the inherited IRA or 401k within 10 years after the death of the account holder. So back in the good old days, people would pass on tax deferred assets like an IRA to a child or a family member, and they would be able to stretch that IRA out over their life expectancy, thereby allowing that account to accumulate and take out distributions during their lifetime. They now have to take that out over a 10-year period. It's not systematic, it's not annual. That person can wait up until 9 years and 11 months, or they can take it out however they want. But at the end of 10 years, that account has to be liquidated. Now, there are some exceptions to the rule, and the 10-year rule includes assets left to a surviving spouse. So the spouse will find here a minor child, a disabled or chronically ill beneficiary, and beneficiaries who are less than 10 years younger than the original IRA or 401k participant. So this was really big if you feel that there's going to be money that's going to be passed on at some point. Now, American Rescue, a stimulus plan recently of March 11, 2021, another $2 trillion program. And in my opinion, a lot of these things were needed, folks, but it did add to our debt and our concerns here on taxes. There were more rebate and stimulus checks that were sent out for single and married couples. There were now tax breaks and household child credits, which they're actually looking to make permanent if possible. Aid to state and cities, additional monies for state and cities, more money for businesses so that they would not lay people off and not furlough people, keep control of the unemployment, more money to unemployed, which if you were collecting federal unemployment, ended on September 6th of 2021, and more money to schools as well. So my case and my concern of the previous slides we shared here. Now, what are the potential changes that are coming? And I would caution you with these upcoming slides, it's no different than what you're reading. I do rely on some financial channels, but nothing you're going to see here is actually set in stone yet, and it's being debated. One of the reasons that you need to understand why is any law, including tax law, needs the vote of the House, the Senate, and the presidency to overturn or change a law. So no president can come in and just drop the law. They need participation from full government bodies here. And so some of the things that are being spoken about right now are raising that top marginal income tax bracket, which is now at 37% to 39.6%. Right now, they're talking about for single people who earn above $452,000 and $481,000 for head of household, $509,000 for joint filers. I have no idea where that's going, but there might be enough votes between the three bodies to actually raise that the highest marginal tax bracket. This one is very interesting. In Connecticut, there are some high net worth pockets in the state, obviously. And this one is they're looking to make major changes to the federal estate tax laws. Right now, it's been raised all the way up to $11.7 million. So if you're wealthy, but you're below 11.7 million, you do not have to pay federal estate taxes. If you're married and you pass away, your spouse grabs that exemption, and then it's $23.4 million. So very substantial numbers. However, this was proposed by Senator Sanders, who would like to actually lower the exclusion to $3.5 million from the 11.7. And if anything is above 3.5 million, Anything above that would be taxed at 45%. So this would be all your investment accounts, your retirement accounts, collectibles, real estate, you name it. If you're above 3.5 million, you might pay 45% on anything above that. The one big thing to remember is in this concept of this 3.5 million, let's assume you had 4 million. Well, $500,000 of that would be taxed at 45%. So basically cut in half. And any tax deferred money, such as IRAs, would still be fully taxable to the beneficiary. So this is just taxing your estate above 3.5 million. Now, one of the concepts they have on generating more revenue and hopefully adding some more life to Social Security is creating what they call a donut hole. If you're fortunate enough there and you're reading that paragraph, right now, once you hit 142,800 in salary, if you're fortunate enough to make that much money, you'll notice more take-home pay because you don't pay into Social Security any longer. What they'd like to do is give you a little relief from 142,800 to 400. But if you make above 400,000, they would like to start taxing that again. This Social Security does need some help, and I'm not too sure how I feel that one will go. I think Social Security needs a much deeper overhaul. They would like to increase, some good news here, they'd like to increase that SALT tax. So either increase that $10,000 deduction for property and income tax, or maybe repeal it. I don't think they'll get the votes on both parties to do that. Corporate tax, this one is a very hot one. They'd like to change that 21% somewhere to 28 or 25%. So they'd like to tax corporate America a little bit more. They'd like to change the capital gains rate. Most people feel or assume that their capital gains rate is 15 or 20%. They're talking about potentially 25 or 30%, excuse me, or depending on your income, taxing it at your ordinary income tax rate, not a flat rate of 15 or 20%. I think there will be some movement on that as well. This one pertains to people with after-tax accounts, such as brokerage accounts or even real estate. Right now, there's something called a stepped-up basis. So let's use an example as a home. If you own a home and you were fortunate enough to purchase it for $100,000 and it's appreciated to $600,000, well, at the time of your death, if you left it to your children, as an example, they would inherit it at the $600,000 and not be responsible for any taxes unless they held on to it longer and it went up from value from the $600,000. Right now, they would like to change that, and I don't know where the magic number is, but they would like to eliminate or reduce that stepped up basis. This would also pertain to stock accounts. For many years, people have held stocks because they have appreciated for 20, 30, 40 years. And if that is inherited by a secondary beneficiary, such as a child, they inherit that as well as a stepped up basis. So I think there is going to be some movement on what we call, excuse me, stepped up basis. Now, I spent quite a bit of time taking a look at the federal government. You also want to keep an eye out for the states. This was a recent study here that showed unintended consequences for Connecticut income tax increases. Again, it was not your state income tax level, it was various other taxes. This recently was New York State talking about raising taxes on millionaires. And New Jersey said fiscal year 2021 budget enacted tax increases. So we're seeing a lot on the state level as well, because the states are also financially challenged. And again, New York State taxes going up for 2021, 2022 budget. Now, I actually recently added this because I've been feeling this pinch a little bit myself as a business owner. And I think that states in general have gotten very creative on how to raise tax revenue, again, without taxing your state income tax levels. And so you'll see here, this, I just pulled up actually this today, coming soon, payroll taxes to fund long-term care program. My daughter-in-law actually lives in Washington State as well as my son. And there's actually now, it's actually been enacted. There's a mandatory payroll tax to fund Washington State's new long-term care program. My daughter-in-law is 29 years old, and if she does not purchase a long-term care policy with minimum requirements, she will get hit with an excise tax for not owning long-term care. It's one of their ways to reduce the burden on Title 19 Medicaid. Over here, this is recently out, and this is going to happen. Why some payments through Cash Apps, such as Venmo, PayPal, will need to be reported by the IRS. So if you're moving money on Cash Apps, depending on the level of $600 or more, it'll have to be reported to the IRS and may be taxable. Internet's obviously becoming a big way for people to do transactions. Business and personal property here, and I actually pulled this one up myself, is my administrative office is in Glastonbury, and we've been paying for the last few years a tax for a copier in an office, a tax for office furniture in the office. And so again, a lot of creative ways to raise your taxes without touching your state income tax levels. Okay. One last slide here that I think will help you build this case, potentially higher taxes. This is something that has been around for quite some time, and it's called Tax Freedom Day. And this organization takes a look at every state across the country, and as an aggregate of their population, assumes how long it takes for you to actually earn your own money. And you'll see here, unfortunately, as much as I love the state of Connecticut, they're estimating it takes until about April 25th to pay all the taxes that you face in this state, including federal and state income taxes, besides personal property taxes, car taxes, and the like. It takes you to about April 25th here. So we're the 46th highest tax state in the country. Beautiful state, but very expensive. Let's take a quick look at the old tax brackets. If you remember, I said there are 7 tax brackets and 7 remained. So let's take a look at the old numbers versus the new numbers, and potentially where I can show you some opportunities that I see as a tax planner. So you'll see here, we're talking about the old numbers. You'll see this chart is from 2016 before the tax changes. And we're looking at married filing jointly. The tax rates in this progressive system, we pay a different amount of tax on different amounts of money that we make. So in this example, 10% from 0 to 18,500. You pay 15% on the monies of 18,551 to 775.3, and so on. More importantly, I'm going to highlight something here, but remember the numbers here: 10, 15, 25, 28, 33, 35, 39.6. You'll see in this 28% bracket, if we made anywhere from 151,900 to 231,450, we paid 28% on that money, or roughly $80,000 in there. Now, you'll see that the rates were lowered. The 10% is still 10, 15 was lowered to 12, 25 to 22, 28 to 24, and so on. Now, one of the opportunities that I see as a tax planner is they actually broaden that range from 171 all the way up to $326,000, and it's only costing you 24% instead of 28%. So my concept is taxes have gone on sale. What have you done about it? This may be an opportunity if you view it the way that I do. Now, how much time do you have for this opportunity? On December 22nd in 2017, when President Trump signed in the Tax Cut and Jobs Act, it cut the individual tax rates and it doubled the standard deductions. It eliminated the personal exemptions, and the top rate dropped to 37%, along with those other tax rates that I showed you. The corporate tax portion of the act went from 35 to 21, and the corporate tax cuts are permanent. So again, you need all 3 bodies to overturn that corporate tax rate. Otherwise, it's permanent. Unfortunately for us, the individual changes that I just shared with you expire at the end of 2025. They will sunset and revert back to the higher numbers. And again, the law can be overturned if the votes are there. So be aware that the tax brackets and rates were lowered, but as of now, only good till 2025, or they revert back and sunset to the old numbers. Now, some good news on the required minimum distribution front here is we're looking at this age 72, and we're looking at the old required minimum distribution chart and the percentages that you had to take out versus the new chart. So the good news, starting next year, they have reduced the percentage that you actually have to take out of the accounts. But here's the key to this chart and why I show it. Let's look at the right-hand side where it says new IRS RMD rules. And you'll see at age 72, if the beginning balance was $1 million, you have to take out 3.66%, 36,630. Let's stop there for a second. Did you know as you get older, you have to take more? So at age 80, it's 4.95%. At age 85, it's 6.25%. Age 90, 8.26%. So as you get older, you're going to be required to take more money out of your tax deferred accounts, such as IRAs, 401ks, and the like. Here's the question that I have for you to help you understand the presentation. If at age 72, I needed to take out that 36,630, did I figure out this chart appropriately for my retirement? And the answer is no, because I would have to pay taxes on the 36,630. I'd have to calculate how much in taxes I'm paying, and then I can determine how much I really need to take out. So in essence, that 36,000 is not worth that. Inversely, if I did not need 36,630, why would I wait that long to allow such a large distribution? And I'll break that down in a minute here for you. So some of the things you want to understand for your own situation. How is your money taxed? Well, it really depends. It can be tax deferred, taxable, or tax-free, which we're going to get into. You have to determine what your tax picture will be in retirement, not just what it is now, and how that might affect your successful retirement. What can you do to address the situation, and can you get close to a tax-free retirement? The big question I've asked people for years, besides are you invested and diversified, is are you tax diversified? So to sum up the first portion of the presentation and to help you understand my concepts here, if I had $1 million in my 401k, well, who's my partner? How much is yours? Well, it really depends on when you take that money out. So figure out how to maximize your money. Now, to help you break down your own scenario here, which is, again, what we do when we sit with folks, we ask them, which bucket have you been filling up? And so we're going to talk about tax deferred, taxable, and tax-free money. And very common in this tax deferred bucket, which is the arena where most people have 80 to 90% of their money, this is the bucket where you never wanted to pay taxes, so you deferred. Now, sometimes there's reasons to tax defer. Maybe your income is too high and it's going to be substantially lower in retirement. But I have sensed that most people tax defer because they don't want to pay taxes. And so you have your workforce employee-sponsored retirement plans, such as 401ks and 403bs. You have your IRAs, and believe it or not, annuities are tax deferred. Now, you're going to find interesting here that annuities are also in the taxable bucket, as we're talking about the gains here. But in taxable, you have interest, dividends, pensions, Social Security, brokerage accounts, and salaries. The asterisk next to Social Security is really pretty simple. Depending on the amount of income you have in retirement, which is all provisional income, pensions, required minimum distributions, up to 85% of your Social Security benefit can be taxed on the federal level. State has some slightly different provisions. Tax-free, where most people want to be in, you have very limited options, folks. You have a Roth IRA, you have municipal bonds, and another asterisk here is called cash value life insurance. I spoke to a couple last night, and they were under the assumption all their money in their cash value life insurance policy is tax-free. And unfortunately, in most cases, that is not accurate. If you fully liquidate that cash value policy, whether it be whole life or variable life, doesn't matter what kind, you are subject to a cost basis rule. So as an example, if I put over the years $50,000 into a cash value whole life policy, and I decide to cash it out when it's worth $100,000, the $50,000 I put in is tax-free, but the excess $50,000 is actually taxed as ordinary income levels, not capital gains. So little asterisk there. So let's go into the first case study. Let's look at the Joneses. And you'll see here they're age 50. They'd like to retire, very common at age 65. They want to reduce taxes if possible, and they'd love to leave a legacy for their child. Their assets at the time were $500,000 of tax-deferred money, $100,000 in a taxable account, and they were putting 6% a year of their salaries into the 401k and making $100,000 a year. Their concerns were long-term care. I've been a certified long-term care specialist now for 20 years. I'm a big advocate of it if it's affordable and right for that person. They were paying $4,000 a year for that. They had term life insurance costing them $3,000 a year, which was going to expire in about 5 years. And they had not started a legacy plan to date. So conceptually, when you're talking about these concepts here, I talk about the seed versus the harvest. And so to help you understand this concept, in this couple's case, there was $500,000 of tax deferred money. I asked them how much they thought they would make on that money, and they said 7%. So when we factored that $500,000 over 20 years at 7%, my estimation is that account value would be all the way up to $1,934,000. What I was more concerned about or interested in as a tax advisor is what would that expected required minimum distribution be at that age? Well, the distribution, and this is an important number to remember, the distribution is scheduled to be about $73,000. And when I looked at their retirement scenario, the distribution was far greater than what they would need in retirement. So if I were a farmer, I would rather pay the tax on the seed at $500,000 as opposed to the harvest at $1.9 million. One of the concepts is Roth conversion. This allows you to shift money from a tax-deferred account, such as an IRA, to a tax-free account, like a Roth. You would pay taxes at your current rate. So assuming they wanted to pay the whole tax amount on this $500,000, and they were in a 30% tax bracket, what would it cost them? $150,000. And this is not a good idea, folks, in general, for most people. So not something I would be an advocate of. But this helps you understand what potentially that $500,000 tax deferred account is worth. And the other question you'd want to ask yourself is, wait a minute, they're only 50 years old. I thought you had to be 59 and a half to take money out of an IRA. Well, the IRS comes along to help you with that scenario if you are below the age 59 and a half. They offer something called a 72T distribution law, and it allows you to take equal and annual distributions from the IRA before the age of 59 and a half. You would have to pay taxes, but you would not pay the 10% penalty. However, the key here is if you embrace this concept, you have to have those distributions go on for 5 years or the age 59 and a half, whatever is greater. So if a 50-year-old couple starts this, they're going to have to do it for 9.5 years. Currently, a 50-year-old can take about 5% of that account utilizing the 72T distribution law. So what we're trying to do here, if you can visualize the buckets that I just showed you, we're trying to take money, in my opinion, from the least advantageous bucket, which is the tax deferred bucket, and we're trying to cross that tax bridge that I talked about getting to tax-free. So we're recapturing money to get to tax-free. So what we're going to do here is we're going to start taking advantage of that 72T code, taking the 5% of the $500,000 IRA or $25,000 a year. We're also going to start liquidating the taxable brokerage account to avoid in the future capital gains, dividend interest income, $10,000 a year. We're going to stop in this case, and this one's quite unusual. I'm a big advocate of the 401k if my employer is contributing. So as an example, if I'm working in the workforce and I'm putting in 5% a year and my employer is matching 5% a year, I guaranteed double my money every year. In this case, the couple was not getting a matching feature, so we stopped tax deferring $6,000 a year. We actually stopped the term life insurance and long-term care because we had an alternative solution for these folks, not because I didn't believe in life insurance and long-term care. In this example, we're recapturing $47,000. So as opposed to converting the whole $500,000 at once, we're converting $47,000 a year to move into the tax-free bucket. Now, if I'm assuming 30% taxes, we are now taking $47,000, bringing it down to $36,500, and we can start moving that money into the tax-free arena. First step in this case, we got into the Roth conversion. After 59.5 or 5 years, all distributions are tax-free. Distributions from here, if you're going to live off this money in retirement, do not cause your Social Security to be taxed, but distributions from an IRA do. And if they wanted to continue to contribute after the conversion, they can continue to contribute up to $7,000 a year based on income limitations. The one thing I should add here as well is there is this misconception if you're not working, you can't do a Roth conversion. That's not accurate. You can convert money at any time as long as you're willing to cross the tax bridge and pay your taxes. You do not need to be working to do this. To contribute to the Roth IRA, you need earned income. So $13,000 a year went into these accounts. We then, in this case, got the folks involved in cash value life insurance with a long-term care benefit to meet their initial objectives. In here, there are no age restrictions. All the distributions, if you're using it as loans against the value in the policy, are technically tax-free. You would pay interest on those loans. Distributions from here do not cause your Social Security to be taxed as well. And this policy offered $10,000 a month in long-term care benefits. That's how we were able to alleviate the annual pay long-term care. And if you remember the initial required minimum distribution, assuming a 7% rate of return, this is now at that same assumed 7%, estimated to give the couple $65,000 a year of tax-free loans. And it also addresses their tax-free legacy death benefit. So $23,500 a year went into this. The dynamics on how this worked for this couple here, there's the premium going in. There's a substantial death benefit of almost $1.6 million, which addressed their legacy concerns. And there's that $10,000 a month long-term care rider. So we were able to get rid of the term life insurance and the annual long-term care policy. The concept of the presentation tonight, folks, is not to tell you what this company is or all the dynamics here. It's to show you how to get in the tax-free arena. And you'll see this was the $23,500 a year going in for 15 years till age 65, because that's when they wanted to retire. Based on that assumed 7% rate of return that they were expecting in that IRA, we're now looking at $65,070 a year as basically tax-free loans. We're maintaining a level of cash here for the folks to access if they need it. And we're also addressing the long-term care needs as well as the death benefit. So the comparison here, if they remain in this hypothetical 30% tax bracket, their money would last out till age 85. If in theory, taxes went up to 50%, they're on a trajectory where their money might run out at age 78. And finally, if they get into the tax-free world, their money should last well beyond age 100 and leave a substantial legacy. So taxes and tax rates can really change the outcome of a plan. The end result here is the clients were able to get tax-free monies into the Roth, technically tax-free money in the cash value life policy if used correctly. We eventually eliminated all the taxes on the IRA, and got to tax-free on Social Security. So it is possible in some cases to get tax-free entirely. Now, I'm going to show you a little bit of the inner workings of my retirement software. My retirement software does a few things as well as have a built-in tax calculator. So what we're going to compare here are two scenarios, and I'll explain each page as we go along here. In retirement scenario number 1 and in number 2, the monies in the plan are going to both grow at 4% every year. Their expenses are going to increase at 2% every year in both plans. However, in scenario number 1, you're going to have $1,798,000 of tax deferred money. So this is the harvest. In scenario number 2, $1,407,000 of tax-free money. In both cases, $195,000 of a taxable account. Let's see how this pans out. So for simplicity for tonight, we'll go along here in the year 2022, and there's John and Mary, they're 66 and 65, and we factored in their Social Security benefits of $4,042, and you'll see their expenses of $83.88. The red column is something you should be aware of if you've never had a retirement analysis. This is kind of an eye-opener. In this scenario, it suggests this couple will need $4,346 every month just to pay their bills. Don't forget, that's a net number. So if you're taking money from an IRA, you're going to have to take out quite a bit more. On the top right-hand side there, you'll see they're starting retirement with almost $2.1 million, or a little bit greater. You'll also notice on the left-hand side, the software at age 72 is going to start calculating all that tax-deferred money and the required minimum distribution. Now, this chart here is interesting to me, and it's something that should alert the potential client here. This column shows me where it starts at 0.98%. It shows me that the growth rate of the money, the 4%, is not going to be enough, and they're going to have to take out additional dollars here. And partly that's because of the required minimum distribution. Because all the money in this case was tax deferred, you'll see that in theory, based on those parameters, in the year 2050, at age 94 and 93, they would run out of money. Some of the questions that came up during this conversation were, how can this change? A higher rate of return, spending less money, really basic things which didn't pertain to investing. Now, for the tax-free concept, you'll see here there are no required minimum distributions. There's no taxation on Social Security. And you'll see here the expenses haven't changed, the Social Security hasn't changed, but the starting point is $1,755,000. It's not 2.1 million any longer, but all the taxes have been taken out of the plan here. And based on that scenario, you'll see at age 94 and 93, instead of potentially running out of money, there's $1,124,000. So folks, this has nothing to do with picking investments in the stock market. These are just static numbers here to show you how profound taxes can play in your retirement. By the way, this question comes up a lot. You don't need $2 million for these scenarios to pan out. It happens on all levels. Now let's go to some basics here. Let's take a look at compounding money tax deferred, such as an IRA versus tax-free. Here's an IRA that's going to yield 4%. There's $100,000 in the account, and I have calculated the required minimum distributions for the next 20 years. Upon passing at age 90, that would leave $73,651 in the IRA account. So between the ending balance and the required minimum distribution, it tells me the account was worth $175. If I took out 25% taxes, $43,000, the end result is the true value of that money over 20 years after taxes was worth $131,428. And money coming out of here can create taxes on your Social Security. Now, on the right-hand side, I'm giving you a hypothetical municipal bond that's getting 4%. And yes, that has not been that type of rate for quite some time. And you'll see the same $100,000. You'll see someone that's going to take that 25% hit and pay the taxes up front. Now there's $75,000 thriving in a tax-free account, such as municipal bonds. And if we factor that money over 20 years at 4%, the end result is 164,000, not 131,000. And distributions from here are not causing your Social Security to be taxed. So in a very simplistic way, seed versus the harvest, both yielding 4%, the turnout is better in the municipal bonds or the tax-free arena. This is an interesting case here. This is using excess of required minimum distributions for people who knew they would have too large of distribution. They wanted to leave a legacy, and they again wanted to address long-term care and have cash reserve on hand. This type of policy allowed people to put excess required minimum distributions into it. It was again a version of life insurance with long-term care. It was built differently though. This one was able to accumulate cash, not aggressively, but accumulate cash. So the cash reserve was on hand, give them a death benefit for legacy purposes, and also allow them long-term care benefits. So the concept of a tax conversion and tax legacy can be utilized in so many different ways. Now, this is really interesting. I've added this recently, and this is to help you understand how, again, taxes exist and how you can potentially mitigate or actually eliminate them. The capital gains rate most people assume is 15 or 20%. And I've asked people for years, how does 0% sound on capital gains? And here's how it kind of works. And this is right off of the IRS site, folks, so you can see this yourself here. It states here, taxable income, and let's again focus on that filing jointly income tax return, up to $80,800 is taxed at 0% if that's the total amount of capital gains. How do you utilize that potentially? First, you have to understand that long-term capital gains stack on top of ordinary income. So take your income minus that standard deduction that we've talked about and add your long-term capital gains and qualified dividends. This is the amount of money on which you would actually pay long-term capital gains. So look at this scenario here. Imagine if you had no income, you were just starting retirement, and you withdrew $24,800 from an IRA. Well, again, if you're a married couple, your standard deduction is $24,800. So the money coming out of that IRA or 401k would not be taxed. Not many people think they could take money out of a 401k and pay no tax. That's one of the ways to do it. Now, if you revert back to the previous chart, if you had capital gains in a stock portfolio, you could take $80,800. You'd pay no capital gains. So in essence, that year you can distribute $105,600 and pay no income tax at all. So these strategies, again, for a tax advisory practice exist on a multitude of levels. Tax harvesting, we're all fortunate if we're investors. This has not been a popular concept over the years because the stock market, quite honestly, has basically gone almost straight up for the last 12 years. Tax harvesting is a very simple concept, and this opportunity, if the market's correct, may endear themselves again. Here's a concept of purchasing stock for $50,000, selling the stock for $80,000, $30,000 in capital gains. Here's a stock purchase of $100,000, selling them at $70,000, $30,000 in losses, so the taxes due are zero. So tax harvesting, though, has not been very popular, fortunately, because portfolios continue to go up. Your outlook may drive some of your retirement strategies, and if you feel that tax rates will be lower in the future, then quite honestly, saving on a pre-tax basis today, such as traditional IRAs or employee-sponsored plans, make a lot of sense. If you think there's a compelling picture where tax rates will be higher in the future, then you might actually want to consider these tax-free retirement strategies using the financial products and instruments that we discussed earlier. In my opinion, once your enough is established, you can then use tax breaks to reduce your tax burden significantly. So with that, Maura, if it's okay with you, I'm going to leave this screen up. If people do want to contact me, that's my phone number, my email address. and something that we have started recently, which is calendly.com/finance and tax. And you can actually go on that site, see a blank version of my calendar, and certainly populate your own information in there. You're welcome to call the office or email me. And as I had said earlier, more happy to send you out some of the packets that we normally give when we're in person for distribution to the folks on the call. So with that, I will come back here and happy to answer questions, Maura, if you have any.
There are a couple of questions, Mike. The first
Okay.
one is, can I convert a 457 to a Roth IRA?
Yeah, so anything in the tax deferred world, whether it's a 457, a 403B, the numbers just represent the type of business, whether it be nonprofit, for-profit. There's a lot of reasons for those various numbers. But in essence, in some form or another, they're really just tax deferred IRA accounts. They're just embedded in a company sponsored plan. So yes, a 457 can be converted as well. You just have to be cognizant of the tax brackets, what you're taking on, and kind of take a look in the future at to what you think your tax rates will be in the future.
Okay. I'm not sure if you can see the chat, Mike, but there's a very specific question that was just sent to the panelists.
Yeah, let's see if I can pull that up.
Okay. You might have to X out of your presentation. I'm not sure.
So I apologize if I'm showing this. If I am, I can stop sharing if you'd like, because I see a chat question about a single file in 2021. Is that what you're asking?
Yep.
Okay. I don't know if I'm sharing it. Would you like me to stop sharing my screen? I don't know if everyone on the call is seeing the question.
No one else can see the question except for the two of us and the person who.
Yep, so I'll repeat the question because it's pretty lengthy. As a single filer in 2021, Social Security is 34,000, pension 16,000, 30,000 from annuity, total of over 80,000. What is my federal tax rate and my Connecticut rate? So the first challenge with that is, as a single filer, most likely you're on a standard deduction, which is a little over 12,000. Depending on your age, it might be a little greater than standard deduction. If you're on itemized deductions, I don't know that, so it's hard for me to evaluate that. The other question, which is a kind of a loaded question, is the most likely scenario from what I'm seeing here is 85% of your Social Security probably is being taxed on the federal level. The big question here is there's $30,000 income from an annuity. If the annuity was purchased with after-tax dollars, there's something called an exclusion ratio where some of that income is a return of your principal, some of it is taxed as ordinary income. So not knowing if that annuity was an IRA or after-tax money, I can't really answer that. Based on these numbers of 80,000 using a standard deduction, my assumption is your aggregate on the federal level is probably about 11 or 12%. State of Connecticut is 5.7%. But again, not knowing some of the specifics, I don't really want to get myself in trouble answering the question. Another question here, what are some of the advice you give to a couple in a fire journey? So I apologize. They need to know what a fire journey is and looking to retire in 10 years in their 50s. So if someone can clarify what a fire journey is, I'm happy to answer that one. Another question, Roth contributions can be made before 59 and a half up to 6,000 a year currently, but that is still only so the question is about how much income before you can't contribute to a Roth IRA or even a deductible traditional IRA. And so they do talk about modified adjusted gross income. The contribution level above age 50 is actually 7,000 a year, not 6,000 a year. Under the age of 50, it's actually 6,000 a year. And I'm not looking at the charts, but it seems correct that if your modified adjusted gross income is below 140, yes, you can still contribute, but I'd have to actually look at the exact numbers. If you're over that, yes, you really can't contribute to a Roth unless you do what's called a backdoor Roth. And for tonight's conversation, it's a little bit more complex. So I'd prefer not to go into great detail on that, but there's a possibility of using a backdoor Roth every year to add to or contribute to a Roth, even though you're over the modified adjusted gross income. Another question, yeah, this is a lot of information to absorb. Can I get a copy of the slides? And unfortunately, as I mentioned tomorrow, I don't share the slides. They are proprietary. I'm happy to give you our handouts, what we give at the presentation, which adds, I think, a lot of value. You're certainly welcome, if you're comfortable, to visit me at one of my offices. There's no cost for the presentations. And if you go to my website, actually, you can see a listing of all our upcoming presentations. Some of you might even enjoy more because we offer wine and beer at some of them. Lastly, financially independent, retire. Okay, so now you know the acronym of FIRE. FIRE is financially independent, retire early, which I love that concept because I've told people for years, retirement is a place called peace of mind, quite honestly. It's not necessarily a magic number that you hit in savings. And so if you can retire early in your 50s and you feel, or a financial advisor feels that that plan is more than solvent money-wise, the only objective for you would be, A, what is the money for? Is some of it for legacy? B, we talked about the longevity, and C, is it tax efficient? But otherwise, if you're sure you have enough money, I certainly, and you're comfortable retiring at 50 and you have plenty of things to do, I'd be all for it. I think that's all the questions, Maura, unless there's any other.
Yep, that's all the questions so far, Mike.
Okay, so I'm happy to stay on for a few minutes. And again, I will send you those packets. If anybody would like to contact Maura directly, she obviously has my contact information, as well as what you're seeing on the screen here. And certainly feel free to come to any of our upcoming events, regardless of the topic. Taxes and retirement is a big one. But certainly we do talk about, and they've had us at Noah Webster on Social Security, long-term care, women in retirement, a host of topics. So happy to see you at one of our future events as well.
Great, thanks, Mike. And I also
thank you,
put
Maura.
my email address in the chat. If you do want it, a packet from Mike sent out to you via the mail, just send me or drop me a email and I will mail it out to you.
And I will have those to you early next week, Maura.
Great.
Okay, this time I'll actually be able to hand it to you. Last time I had to put it on the table in front of the library, so we're making progress.
Yep.
Okay, thank you everyone for your time. Thank you, Maura, again for allowing me to present. And I look forward to seeing you again in the future.
Great, thanks, Mike. And thank you everyone for coming out tonight. I hope you have a great night.
Bye-bye.
Bye.